Hello, this is Mark Singer again with Osage University Partners. We're going to go ahead and get started. So, hello everyone. Thanks for joining our webinar on hardware. For those of you who don't know me, I'm a managing partner here at OUP in charge of our tech investment practice. And today we're going to talk about hardware startups, broadly defined, and in a little bit we'll go into what do we actually mean by a hardware startup from a university. And we're fortunate to have three panelists with us for the discussion. The first is Manny Stockman, who's a senior associate here at OUP on our tech investment team. Second, we have Bob Nunn, who's CEO of Psikick. Psikick happens to be a spin-out from both Michigan and UVA, commercializing hardware technology from both of those institutions. And OUP is an investor in Psikick. And we also have Greg Papadopoulos, who's a venture partner at NEA. And Greg is also an investor in Psikick and has invested in many other hardware companies and many university spin-outs. So we're going to start with some quick background. So Bob, I'd like to turn it over to you and ask you to briefly introduce yourself.
Great. Thanks, Mark. So I am Bob Nunn, and I've spent the bulk of my career with hardware startups. So about 25 years, I've been working with companies in various stages of development, primarily focused on hardware, everything from chips to systems, and now a full solution with Psikick. There was, my last startup company was acquired by Intel, and I did spend a stint at Intel Capital, so kind of on the other side of the table. So have a little bit of experience there as well. For Psikick itself, we are a batteryless sensing solutions company. We do have a hardware component, and actually, as Mark mentioned, the innovation that was spun out of the universities is really around chip technology, ultra low power, both digital and RF chip design. But the real differentiation for the company is how we take that chip design and combine it into a system, providing a self-powered sensing solution, which goes all the way through the networking of those monitors together, bring that data up into the cloud, and then providing analytics on that data. So ultimately, our company goes to market as a hardware-enabled software as a service. So it's really, for us, it's about the data and the insights from that data that the customers are interested in. So it's not that there's less concern from our customers' point of view of what actually was the innovation from the university. It's kind of an interesting twist on how things develop over time. So I'm sure we'll talk more about that as we go along.
Great, thanks, Bob. And one thing Bob did not mention is his previous hardware company that he was also CEO of was a Caltech spinout also. So Bob is involved with two university spinouts in the hardware space. We expect great things from you on this call. So Greg, I'm going to turn it over to you for an introduction of yourself and NEA.
Yeah, so this is Greg Papadopoulos, and you can see my background there, but I think relevant to this call is you know, kind of the three points on the triangle of this. Once as a faculty member at MIT, and having spun out from there a number of startups, so gone through that spin out process from the university side in both hardware and software, as it turns out, and then been on the receiving side. I was at Sun Microsystems for a good chunk of my career, buying startups that came out of universities as well, and then for the past 8 years or so at NEA as a partner there, investing in these areas. And I think you all are aware of NEA. Won't go into detail there, but my focus area is primarily on the tech side, and you know, historically maybe more enterprise style technology, but you know, broad appetite across domains and including hardware.
Thanks, Greg. And I can say, having worked with Greg on the board of Psikick, he's an incredibly forward-thinking technologist, and lucky for him and for Psikick, now having spent 8 years on the dark side as a VC has not dampened his creativity at all. You know, OUP and NEA have had a long and fruitful relationship, so we've now co-invested in 8 university spinouts over the last 7 years or so with NEA, both in tech and life science companies. So as we're going to discuss in the webinar, hardware is a difficult category. It's a difficult category to define because it includes lots of different subsectors, but it's also hard to build a hardware startup. It frequently has required a lot of capital, long development timelines, and fickle customers. So it's made it a category that venture firms have come in and out of and have often left for good. But at the same time, you continue to see investment activity in the space and innovation. And we've seen recently substantial investments in quantum computing, also in certain subsectors of semiconductors and additive manufacturing, also robotics. So it does show that there is interest in the venture world in finding really interesting, innovative technologies that can really radically change industries. And when you can have that, you can attract investment dollars. For us at OUP, we've been very active in the hardware space. So in 2017, we made 5 hardware bets, which is the highest number of hardware bets we've made since OUP's founding. And while the numbers show that investment dollars in the software startups outpace the investment dollars in the hardware startups, increasingly those worlds have started to merge. And every hardware company at this point also winds up being a software company at the same time. And so the combination of those skill sets is really important. So today we want to address a bunch of questions around hardware startups. What's going on in the hardware world? What makes hardware startups hard? As a tech transfer professional or entrepreneur, how do you build an attractive hardware startup and avoid some of the pitfalls of past startups? What are some success stories in this space? And then finally, what are investors looking for right now, so you can think about what are the right kinds of hardware startups to focus on. So we're going to, for the webinar, we're going to have a panel discussion, but we also want questions. So a number of you have already sent questions in advance, which is really helpful, and hopefully we will address them all. We'd also like you to keep sending in those questions during the webinar. So there is a Q&A feature that's on your toolbar, and you can type in questions at any time. We will try to address them as we go, and if it doesn't fit into the discussion, we'll try to address them at the end. And maybe Bob Nunn will offer up a Psikick censor note for anybody who asks the first question. So Bob, are you okay with that?
Absolutely.
Good. So
I don't know what you're going to do with it, but.
So in just a moment, there's going to pop up a poll on your screen just so we have a sense of how many people are attending the webinar today. So if you could answer that now, that would be great. And then before we start the Q&A, I'm going to turn it over to Manny, who's going to present some data around what's going on in hardware.
Great, thanks, Mark. So I thought I'd kick things off by just giving a brief view at a couple different data pieces that we've created around the general hardware and software investing world, but then also some other data pieces that are really specific to the universities that we work with and the startups that we're tracking. And I think it's important to start with a definition. And as Mark was saying, the line is blurred now between hardware and software. So when I speak of hardware, I typically consider a pretty broad range of materials startups, semiconductor startups, but then also, it bridges a gap into robotics, obviously, but then IoT systems and additive manufacturing and quantum computing. So it covers a broad swath, but I like to think of it as bare metal or bare graphene or whatever material you're going after, building into something real. And the blurred line is as chip companies like Psikick create important software businesses for very good financial reasons on top of their hardware innovations. You often sometimes will see in data sources like PitchBook and DataFox that keywords no longer map. And so I just like to comment that there might be error bars on any of these data pieces just because it's not easy to define and search for what's software and what's hardware. And so on the plot here, this is the plot of general venture activity, not university startups, general venture investing in hardware and software. And this is the two key areas that we typically break down the physical sciences side of the university tech transfer world, at least on our team. And the first takeaway is that hardware has traditionally trailed software by a significant amount over the past several years. You can see the red bars are taller than the orange bars, but also note that the axes are not the same. So software has had an average of 5 times more money being injected into the startups over the past 5 years than hardware. And so the message should be loud and clear that software startups really do garner more attention from the general venture community. And while there are a few funds that focus on hardware-only investing, they're few and far between. And so it's really important when you see startups or where you're working with hardware startups that they focus on the investors that are active in the space and know the industry. And the second takeaway is a little more nuanced. Over the past few years, we at OUP, or at least myself, have started to feel a slight flatlining of overall software investing. While a few important hardware domains have started to catch fire, I mean, autonomous cars can bring in hardware angles. Robotics has obviously been picking up steam in the past couple of years, and we're starting to see an increase in the activity in hardware core technology investing, while, as you can see on the plot, some of the software activity is really flatlined. And so there's still a tremendous amount of software dollars, but there's really hasn't been any massive upticks in the past couple of years.
And just I'd call it one other data point. Just over the last 5 years, the hardware funding has tripled from about $3 billion in 2012 to $9 billion in 2017.
Right. So also on the next slide, I've tried to create a little more insights in our world of university investing. For many of you on the phone, I think that's probably the most important thing to think about. And so I wanted to shed light on the data we have that stretches across 5,000 university spinouts. About 500 of them or so are hardware spinouts. And so on the left, I'm showing the venture activity, the venture investment in university hardware spinouts. And so in 2017, startups that came from your universities accounted for just over 10% of the total dollars poured into that domain. This is a really impressive figure when you think about it. I'm still unpacking it myself, but it's great to see that that universities are pushing out a significant number and valuable number of startups in that domain. And I'd also say the venture activity is mapping to the overall trend of hardware investing, increasing year over year over the past several years, and it's being reflected in the similar trend in the university spinouts. And then on the right, you can see the breakdown of how our universities are creating startups. So this is a plot of the number of startups, number of startups by founding year, and other than the general increase year over year, which is great to see for our deal flow, it's clear that universities have a disproportionate number of hardware startups. So this is not necessarily a great thing. When you compare it against the previous slides information on how there's so many more venture dollars available to software startups, you ideally see the same balance in startup creation, but that's not under the university's control. And so that's just something to think about as you evaluate how startups are being formed out of the university. And so on the next slide, I try and unpack that a little bit more. So the real question is, if you can't control the startups that your faculty and grad students and postdocs are spinning out, can you start to encourage them to go after certain subsectors? And this is a view of the hardware startups we have in our database of university spinouts and where they're focusing their startup, the subsector that they're active in. And it's no surprise to see that semiconductors and optics and photonics and electronic components are the majority of the opportunities that spin out. And as DoD and NSF pour money into these very fundamental research domains, the startups that spin out on that research are going to reflect that. And so this, the sheer number of startups that are created in these sectors is important to think about, just because you want to make sure that they're mapped to the venture dollars that are going into them. And so on the next slide, I overlay the past 2 years of venture activity in university startups in these specific subsectors. So these are the startup dollars that the 500 or so universities hardware spinouts have raised. And it's great to see that, given that there's so many semiconductor startups out there, that there's a significant amount of capital going into them. And that's a trend that we hope continues. And there's been a lot of buzz around AI chips and low power chips over the past several years. However, it's really, obviously glaring that optics and photonics and components really aren't receiving as much venture attention, despite having a number of startups created in that space. And that, I'll just also mention that, when you look down at quantum computing, which just over the past 2 years have received a significant amount of attention and a lot of startups being spun out, it's still too early to tell whether that will be a huge growth area like semiconductor, where we will see dozens and maybe 50 or 100 startups in a couple of years, or if it might suffer the fate of something like metamaterials, which was really an active and interesting area for university spinouts the earlier part of this decade. But for the most part, there hasn't seen much growth in the number of companies. It's really been a few of the companies that had core technology in that space, planting their flag in the ground and successfully over the past couple of years pushing out product without much competition. And so these are kind of some of the key insights that I think we look at Osage, and I hope is valuable for you all to think about. And we'll jump into kind of some of this discussion on interesting areas in the rest of the talk. But for now, I'll just pass the mic back to Mark.
Yeah, and let me already thank our audience, because we've gotten a number of questions so far about some things around licensing terms, which we'll address later, but also specifically about this chart. So Manny, I'll ask these questions to you. So first of all, what's an example of a consumer hardware startup from a university?
Jibo is one. So Jibo is a consumer hardware startup that came out of MIT, as is Oculus was one from several years ago that spun, it was affiliated with USC. And so there's a number of large and well-funded startups in this space. And I'd say in general, the consumer startups out of universities are not, they're typically funded with few companies funded with a large amount of dollars. So it's very hard to hit in that space. We don't actively look at it at Osage, but there have been a few successes out there.
And for those of you who don't know, Jibo is a consumer robotics company similar to Alexa or some of the other connected devices in the home. And then a couple of people asked the question of what's in the other category. The other category is so big. Can you unpack some of the pieces of what's in that? Yeah, sure.
Some of these companies, honestly, it's a classification within Osage, and it's anything from new materials technologies to analog sensor components to almost it's water filtration, things like that just don't really fit any of the specific buckets we have in our subsector list today.
Great. And then, Greg, I'd love to, while we're still on the slide, kind of turn it over to you and talk about some of the hardware-related sectors you at NEA have been investing in and are interested in, and some of the areas you've been staying away from.
Yeah, I mean, just, I think we'll get into this conversation a bit later. At a pure hardware level of thinking about components and materials is an area that is really challenging to invest, and we can talk about why. The things that have really inherently more of a, kind of a vertical value you can get out of building systems and fundamentally mixing software in are ones that get really attractive and where you can then see hard ROIs on those things. So even in the sensor space, for example, that would normally kind of get lumped in with something like semiconductors as kind of a difficult thing to do. But if you you start to apply those sensors into particular applications that are important to an industry, and you're providing the rest of the system for that, then those can be really vibrant and exciting companies. We can talk about that too. But I would say, there's certainly pretty heavy interest these days in anything robotic and autonomous. That's there. There's I think a resurgence of manufacturing technology and certainly additive manufacturing, but also just getting onto manufacturing floors and working on things there. And then, kind of the exception that proves the rule is quantum, which is by far the most speculative on here, but it is also the one that I think everybody recognizes has the potential to change the game and kind of an ultimate disruptor. So that certainly garners interest from us.
Okay, good, thanks. And I'd say when I look at the chart, I'm surprised the robotics number isn't larger. We've done a number of robotics deals, and it seems like there's a fair amount of investor interest in robotics. So I would have felt the funding dollars that would have come through would have been larger. And I'm not quite sure why. I don't know if it's because universities themselves aren't creating that many robotics spin-outs. Manny, I don't know if you have any insight into that.
Yeah, I think we've seen, a lot of, I just look at the history of robotics so far, and there's been an incredible number of startups that have sort of been created out of the Google, Boston Dynamics world that don't really get attributed to a university. And a lot of the buzz also in robotics kind of ends up falling in line with some of the autonomous car industry. And those don't classify, at least by our definition, in that domain. It's something that I was surprised to see also.
Okay. And then one last question on this slide, and then we'll move on to some broader discussion topics, which is clean tech. Are there clean tech startups that are in these numbers, Manny?
For the most part, yeah, clean tech has been pulled out of here. It's a different category for us, but it's something that I think maybe going forward I could bring into the analysis.
Okay. Okay, great. Well, thank you, Manny. So to start the actual discussion, it'd be great to talk a little bit about why hardware is hard. So we're going to break this discussion into three categories from here. One, why is hardware hard? Second, how do you go about building an attractive startup? And then finally, who is succeeding in the space? There are one or two questions we've gotten already around success stories in the space. So, Bob, I'd love to have you talk about what makes it hard to build a hardware startup in general, and then what are some of the specifics around dealing with university technologies that either make that easier or harder?
Yeah, when I think about what makes it hard versus a pure software company, the thing that sticks out to me is the capital requirements, but that's really driven by the aspects of being a hardware company. So I think the bottom line is that with a hardware-based product, the time to develop the technology, perfect the product, and release it to the market is longer. So you have an inherent time to market lag versus a pure software play. And then also your ability to what I'll call the release cadence of that product, so to do revs of that product, is longer. So to do Gen 2, to change the hardware, there's a lot more that goes into it than just doing a new software release. So those two things combined mean that it takes longer to really get going and to start ramping the revenue for the company, which relates back to you need more capital. And so that's one of the key things in terms of university spinouts with a hardware component, is that the capital to get to a critical mass is probably the most important thing. Having the money to get to that point where you've got hardware demonstrated, you've got customers that actually want to buy that hardware. So things that take away from that capital and therefore that runway are of critical importance. And I'm thinking in terms of, I know there's been some questions around licensing fees and how do universities get compensated for the IP that they spin out. It's really difficult for hardware startups to afford a lot of IP charges in that early stage. It's much better for the companies to be able to get to that product and start ramping a company before they start paying those IP fees. And
to explore that further, I mean, it'd be great to relate this to Psikick a little bit. So Psikick kind of has been on a journey where it started with some great chip design innovations and has migrated to building a full system. So it'd be good to have you talk about that story of what's happened there. If there were ways to, if you were to do the same thing again, how you might speed it up. So as people think about starting hardware companies, how they can try to shorten their development cycle and also reduce their capital needs.
Yeah, I kind of laugh because my first hardware startup, it took us a long time to kind of figure out what we were offering to the market, how the innovation that we created really was valuable, and then be able to create products to capitalize on that. And I thought, boy, I've learned from that experience, I'll do it much faster next time. And yet, again, I went through the same process. And it's the same process that Psikick has gone through. So the real issue is that, the two professors that started Psikick had a vision in their mind of low power SoC that could be used in the IoT space, could be broadly used by everybody. To really create this batteryless revolution, you would need a new chip that was 1/1000th the power of what traditional electronic circuitry ran at. And so that's a great concept. Then you get going, and the reality of the market kind of shakes your whole fundamental view of how you're going to make money with this. So in their case, as they got going in the IoT space, they found that, boy, there's too many different standards. They don't know which standards to focus on to be that broad-based IoT supplier, and that the market's really not scaling because the customers are not adept at buying the different platforms and pieces and putting together full solutions. So really, it became clear over a period of a couple of years that to be successful in the market, you really had to provide a full solution to the customer. You had to make it easy for them to adopt your technology. So Psikick went from being, well, we'll just do an SoC and sell that broadly to the industry, to today we're very focused on specific manufacturing assets that we can attach our sensors to, collect data that other people can't get because we are batteryless, and then provide insights to that data back to the customer. So it's the presentation to the customer is that we can very quickly, easily install our sensors and provide you insights back. And again, we're a million miles away from that concept of, well, we'd make a chip that's 1/1000th the power of traditional chips. But I'd have to say every hardware startup I've been involved in has gone through a similar type of discovery. And that was part of my intro was that the innovation up front gets turned into something else in terms of differentiation over time. And I think that's a reality of being in the hardware space, probably a reality of a lot of startups. I'll let Greg comment on that.
Yep. Can I jump in here?
Yeah, please do.
Yeah, I think you stated that super well, Bob. Let me add some things in there. I mean, it's sort of an obvious thing, but hardware startups also contain software, and actually, when you talk to most companies as they mature through this process, they begin to realize they have more software engineers working for them than hardware mechanical engineers or material scientists. I mean, that's typically true. And that, making things is just harder because, atoms are harder to deal with than bits. But there is a broad industry out there. Things like fabless semiconductor manufacturing actually predated cloud, if you want to think about leverage for a company. I think the capital requirement in there is it isn't the total amount of capital that a company needs, because a really successful software startup, most of them consume a tremendous amount of capital as they need to go scale customer acquisition and sales. And, you can be talking about hundreds of millions of dollars for a successful software startup. I think that the challenge in investing is it takes you more capital to figure out whether you have one that you want to go put the gas on into. So there's that time and the amount of capital you have to apply to figure out whether something's really worth pursuing. And we can talk about some of this a little bit later, but where it gets really tough is in a lot of these technology areas of when you want to get it at scale, and you have this challenge of manufacturing at scale or yield or competitiveness, and your ability then to fix something that isn't quite right is of course much harder. So I think it's really the amount of capital to get to those points where you really have conviction.
Yeah, and I would echo that. So we face that challenge all the time with companies we're considering investing in and are investing in. Of how do you know you have a viable product that really addresses a major customer pain point that you can scale early enough in the life cycle of the hardware company to want to continue to plow a lot of capital in it. And so whereas with a software company, you can get to a beta product within a year or 18 months of starting the company, and so you're actually in real customer engagements very early. So do you have any perspective as to how a hardware company that has that challenge, in particular, in this case, a university spin out, can go get a market feedback early and try to shorten that cycle so you at least have some conviction that there really is a viable product to be built?
Well, there are a number of techniques depending on, kind of the domain. But one thing I really encourage people to do is not go for the perfect, and really, what are those prototypes that you can go build, or things that you can take, off the shelf, and basically test what your thesis there, even though you may not make money off of it, right? I mean, you just kind of let those prototypes drive you to do that in very focused areas. I mean, I think that sounds kind of obvious, but I think in the hardware side, there's a little more, willingness, at least certainly from us, to say let's look at something in a very specific way, make sure that it works in that very narrow setting. And if it does, our imaginations are great to go, have it take over the world. But we've got to go prove it out. So that sort of early focus, that willing to do rapid prototyping, actually to be as close to a kind of software thing as you can. Those things are things that we look for. Versus the, hey, it's gonna be 2 or 3 years before we get our first chip, and then we're gonna have people design that in, and then et cetera, et cetera. Those are just harder, and it has to be something really special to get me to want to go down that kind of path.
Yeah, I agree with that completely. There are things that we do in terms of, like, if I apply it to Psikick, the concept of removing batteries from sensors, and is that important? We can actually go out and validate that even without the hardware and say, here's the vision. Why is this important to you? And so that work you need to do early, and you need to have the confidence that you're actually doing something that the customers that you're differentiated from the many competitors doing similar things, and that the customers will find valuable. So that's critical work in, I guess, either hardware or software. But again, because of that time delay Greg was talking about to get to that first product, that's a critical step that you need to do to validate your ideas.
And Greg, is there usually kind of a key proof point that would trigger your interest from an investment standpoint?
Yeah, this depends a lot on the domain, but I actually, look, I'm super optimistic of the area. So particularly if you talk about things that people would put into, industrial IoT or into additive manufacturing, I think the sizes of the prizes there, if you will, are so big. Hey, just so everybody checks in on this, what's the world's most valuable company? Is it a hardware or software company? And your answer is it makes things, right? It's Apple. And even the second most valuable company, Google, makes a surprising number of things to accomplish their mission. And so, making things can have really rich rewards. I actually think that the opportunities are so fantastic now in these areas that you can insist that on a really kind of hard ROI when you look at these projects from the customer's point of view. So, I have a very strong filter on, can you show me a customer that if the technology works and they adopt it, they save a ton of money, and they get a payback within a year of deploying the technology and, right? And you can really quantify it, and you can see the budget, you can see all of that. Those are the things that I think make for a really powerful case. And I must say that, to give Bob a bunch of credit here, that, this is precisely what he's done with Psikick now. and that certainly reinforces the willingness to keep investing in something like that. So you can get to hard economics on these things.
And I'd say, and by the way, I think we've largely transitioned to kind of how do you build an attractive startup. So we'll go ahead and kind of advance the slide here. But we've seen a similar dynamic, and again, Psikick following this path of where you create a pathway to a product or an initial product that may not actually be based entirely on your innovation. Only in part because if you're building, let's say, a new chip, it takes, as Bob mentioned earlier, a long time to develop the chip, but you can use off-the-shelf parts to get a workable solution and go test that while you're building your product at the same time. So the earlier you can build a semblance of a product and test it in the market, even if it's not kind of the ultimate product you want to deliver on based on the true technical innovation the company is founded on, I think of it as worth doing, because the sooner you can get customer feedback, the better. Maybe in terms of kind of some of the other questions around how do you build an attractive startup, it's worth talking about management. So, Greg, how do you think about backing PIs in companies, and when do you think is the right time to bring on a non-scientific CEO or co-founder?
That's a great question. It actually ties into something that we've kind of talked around, but not directly here. I'll just divert for a moment. The way you intercept value to the customer and is by solving problems and solving their pain. I mean, these are sort of obvious horary things to say. But to do that, you actually have to offer something complete. And, that solved the customer's problem. And that almost always means that you're delivering a system rather than a component or a technology. And in that case, it's a many discipline kind of thing. And there are a bunch of moving pieces to make that happen. Typically the PIs that we see out of universities, don't naturally live in that full system setting. I would say actually the co-founders of Psikick were surprisingly systems oriented in terms of if you looked at it at the chip level. But even there, there really was not like a strong software component to what they were doing. And so I think that the PIs are really tremendous in the proving out the fundamentals of the technology and basically the bet, because the reward is you do something that's hard and you get on the other side. It's hard for somebody to follow that track. But fairly soon after really verifying that you have that keen and sharp differentiation, you need somebody to help you synthesize the picture and to build that systems company. And that's where we look for other people on the team, and that may be a CEO, it may be other roles, but certainly at almost a co-founding status is to get people who can really bring that systems customer view.
Great. And, I would say this is, a common struggle that we face around PIs, both wanting to run their company, struggling to find the right outside CEO, perhaps finding somebody who may not be the perfect CEO, but is a willing participant in kind of the founding of the company. And so it's a constant struggle. And the way we always think about it is it's okay for a PI to be in charge to get the company off the ground as long as they are not looking to hold on to that position. So where the biggest red flag for us is a PI who says, I want to prove myself as CEO and I want to be here as CEO until I've proven myself. And that usually for us is a red flag. We will fund companies where PI says, I'm looking for an outside CEO, I'd love your help. The moment we find the right person, I'll step aside. And that's a much better situation for us.
I agree completely.
And I would add that it depends on the PI. I've done companies, where I start with the PIs from basically their garage, and then like in the case of Psikick, they were already in business for a few years before I came on. And it really depends on their sophistication as to how long you take before you bring on those partners that Greg talked about. In the case of Psikick, I think it was fine to do the technology development and the initial work. They didn't really need me, but as we get ready to go to market and start to engage with the customers, that's when you really need to bring in that experience.
And I'll add one thing, which is that the first non-technical CEO or person on your company does not have to be your CEO. So a lot of times I think universities have entrepreneurs that loom around the university campus and are helping the startups by adding value and planning out the business strategy. But they don't have to be the CEO. There's a lot of different roles that they can take, because you don't have Bob Nunns running around campuses looking for their next gig typically. That takes time. It takes a little bit of venture backing to attract someone like that. And it's always risky when you bring someone on as a CEO that isn't the right fit, because it's very hard to make that divorce. And so we always encourage startups. It's great to bring in a non-pure technical person, but they don't necessarily have to have that executive title out the gate.
Yep, I agree with that.
Now, Greg, is there, from your standpoint, is there any, given that we've talked about a hardware being a combination of a lot of different areas, each of which has their own dynamic, if you were a participant on the call in a tech transfer office of a university, and you were going to comb the university to look to start a hardware company in any one space, is there any one space you think is most attractive, easiest to fund? Is it, I know it's a hard question to answer. I'm curious if you have a specific area of interest.
Well, I do have, a specific area of interest, I can say kind of broadly, which is, where IT isn't. It's really looking at, the kind of vast swaths of really the world where, we haven't had computing and networking and, kind of a very data-centric view of the world. And that's in most industries across, infrastructure, manufacturing, agriculture. You can go through sector by sector, and mostly we don't have a digital world. I think, we get mistaken or misled at times by, seeing maybe the mobile revolution or the automation of digital businesses, but most businesses aren't that way. And so that's typically these things that involve, sensing, automation, maybe broadly IoT meets robotics, are areas where you see, just tremendous opportunities to go after really fundamental changes to the way that we, build, maintain, just live. And I think those are really broad areas. The areas that are still really challenging are actually ones that you don't see a natural relationship to a system, to a, being able to go pretty vertical into a problem space. So, if you talk about materials or clean tech or, things like batteries, which we've done many investments in, over the years, and none of them have turned out. And I think those just actually get more and more challenging as you go forward, just because there are no natural system expressions of these things. And all of those have the quality that I just named, that, you have to get to some sort of scale before you know whether you have something that actually is going to take to market.
Okay, thank you. And then before we kind of move on to the next group of topics, Bob, it'd be good for you to talk about kind of two of the questions that are on here. One is, like, how do you combine the software component into a hardware company, and how do you do that early on a limited budget? And then second, I'll have you talk about the last question on this slide of, like, how do you balance doing something well narrowly versus being kind of overly ambitious within a single company?
All right. To the first question, I agree with Greg's earlier comment that a hardware company always includes software, and inevitably the software component of the hardware company becomes a bigger resource in terms of the engineers working on the software side of things. So that's been true for a while now. The hardware companies include software, and it's a big part of what we do. The concept of delivering a service with using hardware as a differentiation is a fairly new concept, but we're seeing it more and more now. So your question specifically about what's it mean for it to be SaaS for a hardware startup? I think SaaS is getting thrown around a lot. It stands for software as a service. To me, service is the key feature, and Psikick has embraced this and decided that really what the value that we're bringing to the customers is we're gathering data from assets that they traditionally can't get data from, and then we're able to provide insights on that data. So we're actually going to sell the customer the insights, using that data and advanced machine learning data analytics tools. We'll tell them what's going on in a way that would be helpful for them to save money or improve their operation or be more efficient. And so we're really selling those insights as a service, but we couldn't do that without the innovation and then the hardware, the sensors and the networking systems that we've created around that. So it's really hardware-enabled service delivery is what I think of as SaaS for a hardware company. And I think we'll see it more and more. It's a great business model for us, but it ultimately solves a problem for the customer that they're getting exactly what they want, which is those insights on the assets, as opposed to little pieces of the puzzle that they have to try and put together.
And I really want to emphasize what you just said, Bob. I think when you touched upon things like you're really about getting data and analyzing that and understanding building models, all of those things, man, that's gold. And Mark, something that we really focus on now is what is the data cycle in these companies. And when you hear Bob talk about that and giving people insights into how their factory is running, that's a really long distance from the sub-threshold innovations that founded the company in chip design. So yet it's only possible to do that when you said you heard that well, we can go measure things that you couldn't measure before. Well, that's actually a direct consequence of the innovations that came out of the university. But it gets cast, the value gets cast in terms of this data or SaaS-like offering.
Yeah. And it's not just the SaaS-like offering, it's, as you said, it's what you do with the data underneath it. So, to replay a conversation we just had at the most recent Psikick board meeting, kind of machine learning now is basically kind of table stakes for all companies. And so you need to be able to both collect large data sets and know what to do with it. And so having kind of the algorithmic expertise, the data collection, the algorithmic expertise on top of the software capabilities is really important.
So, Mark, to your second question on the vision versus ambition, it really does lead into your next section, which is how to find the right investors. So, to me, you have to align how ambitious you are as a company with the investors that you bring into the company. And that goes both ways. If you have a grand ambition, a grand vision, you need investors that both have the resources and desire to fund something like that and the patience to make it happen. If instead you're looking to make a difference in a very specific area, there's a different set of investors that will be interested in that. So to me, the most important part of matching the vision is matching it with the investors that you bring on board. And I tell this to entrepreneurs all the time, that they need to be careful what kind of money they bring into the company based on their vision. But the other side of it is that the ambition, I think, needs to be, you need to be doing something other people haven't done. So that by its very nature, you are being ambitious. But as Greg pointed out earlier, there is a minimal viable product of what you can do to get started. So to me, you can have a grand vision and a grand ambition, but actually implement that with something very practical that says, okay, here's the first demonstration of what we're doing, and then be able to quickly increment on that to get to the bigger picture. And that is very true for Psikick. Where we see the world, what we eventually see we are enabling is probably 3 generations of technology cycles for us away. Well, 2 now, but it is still there in our mind that that's where we want to get to. And so decisions we make today, like getting to market quickly, the size of our sensors are too large and probably too expensive for where we want to get to, but those are things that we will fix as we move along in the development of the company.
And I'd say our own experience is selling a big vision can actually help you raise a lot of money. And like as you said, so you need that vision, but it also, selling a big vision also often gets in the way of effective product development. And
right.
so companies we've invested in that sold a big vision and raised a lot of money then struggled because they were trying to do too many things after the round closed and did not do any one of those things particularly well. And so I personally, as an investor, am biased towards companies that sell a slightly smaller near-term vision, raise the appropriate amount of capital to do that, and then do one thing really well, and then capitalize on that success in the long run.
Right.
Great. So why don't we jump to the next slide, which is around hardware companies that have raised money and had success. We got some questions from some of the participants around this. Manny, do you want to just call out a couple of companies here? And
yeah, sure. I think I would just highlight that there's a blend of companies here from our portfolio, from NEA's portfolio, and if you look at some of the other investors in this space, they'd be common investors. And so once again, just want to reiterate, there are the right investors for hardware startups and there's the wrong investors. And I encourage you all to reach out to us to find out who's active in the space. I think there's one common theme through all of these startups, and it's really, except for one that I'm looking at right now, Appeal Sciences, they all have a strong software layer on top of what they do. And that's really important. And as Greg and Bob were both saying, you know, the other is that from our experience, at least knowing every single one of these companies, we haven't invested in all of them, but they've all shown a tremendous ability to build quickly. And that comes from making compromises along the way and not necessarily sticking 100% to your original vision, and being able to prototype and productize very fast and align that with simultaneous customer identification. And so, you know, I think that's really kind of where I'll leave it on this slide. It's really just an interesting set of very successful startups.
And then I'll follow it up with a question from one of the participants, and Greg, it'd be great if you could comment, which is the buzz around quantum computing real, or is it being driven by Microsoft and IBM?
Yeah. I think it's going to be a journey. So it's one of those, you know, overhyped into underhyped in 10, maybe 20. I think the interest in quantum computing is, you know, its potential to sort of stand the computing world on its head eventually, right? But there's a really long journey to get there, which involves, you know, how do you actually make this stuff, and how do you use it, and how do you program it, and you know, we have vast ecosystems around computing as it stands today. So I think, you know, the most intense interest I've seen in quantum computing, maybe not surprisingly, is from folks like Amazon, which you know, they have to be looking out in the long run of, you know, if there is a fundamental shift in technology underneath, you know, where does that leave them? And you know, they better stay in front of it. But this is not a real soon now kind of thing. That this feels like it's in the 1 to 2 decade area to really, I think, make a difference.
Right. And what's interesting about it is we agree with that perspective, but you see lots of funding activity today well in advance of that. So I think how it all plays out from like a venture funding and a startup landscape standpoint remains to be seen. Well,
it absolutely. But again, you know, you look at also, as I talk about the size of the prize. I mean, you know, if quantum computers are commercially successful, I mean, you have things like Amazon that and Google's infrastructure and everybody's infrastructure that that changes out over time. That's a really big outcome. I'll have to say, like, our longest term, company investment out of NEA is in a fusion energy startup, which is 15 years old, right? And Tri-Alpha Energy, and that has that same kind of thing of, this is a long journey, but for the company that actually solves fusion energy, it's fundamental.
Okay. Good. So with our last, we're coming up over the top of the hour. We had a number of questions around licensing approaches and terms. So we'll try to hit as many as we can with that time. So one is relates to the conversation we had, where ultimately the product you wind up building out of a hardware-based university startup is often not really what you started with. So there's a question of how important are the patents from the university at all? And should the university be filing for patents around hardware startups, and how should they think about, how should a tech transfer office think about this, that whole process?
Maybe I'll just start quickly, is think about tech differently than biotech, than pharma, when Bob said this early on, when you take in a license from a university and you're actually paying royalties on it, that's a tax on your company. That the incentive in the company is to really design that out and to look for ways of engineering around it. And so that's exactly what you don't want to happen. And so to sort of line up those interests are, I think in the tech companies, having universities take equity in the company is a much better way to do it. And then the patents, I think, on fundamental things, patents are always useful. There's no question about that. I think that as the patents start to drift more into the space of trying to conceive of the whole system, those things tend to move around quite a bit as you go through your journey.
Yeah, I agree with that, and would add that per my earlier comments, the bigger the drain up front, the harder it is for the company to succeed. So I always like to work with a tech transfer office that is willing to share in the success of the company, but give us a chance to get there. So that's taking equity in the company is the best example of that. But even from a royalty stream, structuring something that says, okay, royalties are accruing, but they're not paid until you get to certain business milestones. I think that's really the key, because then I don't have to worry about those. And when I get to those milestones, I'm happy to pay you, because it means we've achieved a certain level of success. Otherwise, if they become a barrier, if there's something that's always in the way in conversations with new investors, it does inhibit the success or the ability to go build the company.
Great. And then there are a couple of questions that came in that commented around the fact that how do you license technology when these companies wind up being hybrid hardware and software companies? And are you seeing, if that's both pieces of that technology stack are at the university at the inception of the company, are you licensing both hardware and software at the same time? Are there separate licenses? I'd say to answer it quickly, our own experience here is that usually the software component is developed over time at the startup once it has spun out of the university. So generally, in our experience, a university-based hardware spin-out is based on IP from the university around the hardware itself. And then all of the software and data science that comes later is developed internally at the company. So usually there's simply a hardware-oriented license. I don't know if Greg or Bob, you have any different experience around that.
No, I think that's right. And a lot of the, I would say the vast majority of software spin-outs we've done from universities have been open source.
Yeah. And then perhaps as a final question, because it is, we're hitting the hour, there was a specific question around how does the venture community feel about liquidation fees rather than equity? So as context for this, as we see universities experiment with different licensing terms, some of them have said, geez, equity is a hassle, we don't want to take it, and instead they take an exit fee. That's like a flat percentage, a modest flat percentage of the transaction. And so, Greg, do you have a perspective? Have you done deals that had that in a license? Do you have perspective on a
Yeah, we have, look, I mean, the easiest thing for everybody to understand and gets everybody on the same side of the table is equity, and I don't think people should be afraid of that. Second in line for me is sort of these non-dilutive equity is the other way to think about it. That's what an exit fee really is. It's just saying, I have 1% of the company and it doesn't matter how it gets capitalized. I think things like a 1 or 2% is actually can be digested and dealt with. As you get into larger numbers, you really do start to affect the optionality of the company in the future, particularly if you do recapitalize the company or it's a longer journey than you think, et cetera. That starts to put things at odds and may make the company unviable from an investment point of view. But I would just leave it as, man, just join everybody, because then you align with the founders and the sources of venture capital if everyone sits there as equity holders.
Yeah, I would emphasize that and say that every startup is a journey, and it's, when we do the tech transfer at the beginning, we have a certain idea of what that journey is, and the actual journey can turn out to be something dramatically different, as in the case of Psikick. The enabling IP is still important, and there should be a return for that, but the trying to optimize each patent and each and every interaction can get in the way of the company's journey. Really, you want to jump in, be part of that experience, and then benefit if it's a successful journey. It does put you in the position of sometimes it's not successful, so you can license IP that doesn't materialize into big capital or commercial success, but that's Greg's whole business, right? He's got some winners, big winners, and a few losers that happen, and that's really the best way to try and capitalize on that IP, in my view.
Great. Well, so we're just about out of time. So first, we'd like to ask for your feedback. So we learn by hearing from all of our participants about what works and what doesn't in these webinars. So you'll notice in the chat box that there is a link for to provide feedback. So if we could ask everyone who's participating to click on the link and go ahead and fill out the feedback survey, that would be really helpful. And as we wrap up, Bob and Greg, I just want to ask you, is there anything that we haven't covered here that you think is important for this audience to hear?
The one thing that jumped out at me, we talked about why hardware is hard, but there's also a benefit doing hardware companies, and obviously I keep doing them. They create barriers to entry that are unique and different. There's a stickiness to the hardware with your, the engagement with the customer is different. And so as you get through that initial stage and that longer time to market, you can actually create barriers that make it harder for other people to come in and disrupt you. So there's a positive side to the hardware business as well.
We agree.
Yeah, and one of the reasons why we look for it, I would just, I would also just go back and maybe emphasize people should be taking away this sort of systems and data-centric view of how they go approach those hardware companies. Because if you're able to do that and create these barriers because of the actually having physical things somewhere, that can make for a really enduring company. And again, I only remind people to go look at the most successful companies in the world.
Great. Well, with that, well said. So with that, I'd like to thank Bob, Greg, and Manny for all of their great participation in this. And thanks to all of you for participating. And please do, again, fill out the feedback survey so we can learn. And we appreciate everybody joining us for this webinar. And we'll be having our next webinar in the next couple of months. And once we have the date, we will send that as well. So we're going to go ahead and end the webinar now. Greg and Bob, thanks again. We really appreciate it. This was terrific.
Yeah, thank you.
Okay, take care.
Thanks.
All right, thanks.